Banking stocks aren't just safe, they are a smart bet for equity investors riding this wave. Did you know Indian banks are quietly laying down the foundation for India's $10 trillion economy? The banks are revving up our future. Once bogged by bad loans and red tape, the sector is now a digital powerhouse drawing billions in foreign cash to ignite growth. In this video, let's find out how FDI interest in Indian banks is getting charged up and how it will shape our rise in the near future. We'll discuss the reforms making our banks global magnets, their impact on GDP's turbo boost, everyday wins for you and me, retail investor tips, and bold future projections. Let's rewind the clock. Picture India in the late 20th century. Banks were nationalized in 1969 and 1980 to serve social goals, expanding rural reach, but they drowned in inefficiencies. They were saddled with high non-performing assets or NPAs, from forced lending to lax oversight. Today, banks handle 20 billion transactions monthly, and strategic mergers have created tech-savvy giants. These layered policies turned vulnerabilities into strengths over a decade. Let's talk briefly about the powerhouse policies like RBI's 2015 NPA initiatives to identify and slash bad loans, aided by 2016 IBC and UPI's explosive digitization reducing cash dependency. The RBI's NPA initiatives, starting with the 2015 asset quality review, exposed hidden bad loans and improved asset qualities, reducing public sector NPAs from 9.1% in 2021 to 2.58% by March 2025. That is a phenomenal improvement, supported by tools like prompt corrective action for rehabilitating weak banks and enhancing provisions for shock absorption, aided by 2016 Insolvency and Bankruptcy Code, which shifted debt resolutions to creditor-led efficiency, unlocking 26 lakh crore rupees in resolved debts, with recovery rates rising to 32%, combining with digitization through UPI's growth, which reduces cash dependency and boosts fee incomes, plus complementary reforms like GST for simplified tax and co-lending for MSME partnership. Together, these create a framework for trust, positioning banks as a low-risk option in the vulnerable global environment. So now, the exciting part. Recent tweaks like 2020's security scrutiny balanced by incentives have sparked a surge. FDI inflows in banking hit $18.62 billion in Q1 FY26 alone, up 15%. Reversing years of drought, investors eye criteria like rock-solid regulations, 7 to 8% GDP growth forecast, and digital prowess. And here is the investor perk. Valuations are soaring. As of October 2025, analysts from Jefferies and Goldman Sachs predicted 20 to 33% upside for stocks like HDFC, ICICI, Kotak, SBI, and Axis, driven by improved ROE, low risks, and festive momentum. But does this boom stay at the top? Absolutely not. It fuels GDP and trickles down to you and me, with banking as 27% GDP share and deposits of 72% of GDP. These inflows enable 15 to 20% yearly loan expansion, funding infrastructure, 10% of GDP, and MSMEs, over 30% contribution to GDP. The efficiency costs cut by 20 to 30% per private investments and jobs. Think like 1 million new fintech jobs by 2025 alone. This GDP uplift transfers to the masses. Affordable loans spark rural businesses. Higher tax funds welfare like schools and subsidies. Digital inclusion empowers women with microfinance. Poverty drops, human development rises, equity in action. This GDP for retail investors like you and me, this is actionable gold. Use these insights to diversify into banking stocks or ETFs like Bank Nifty. Allocate 10 to 20% of your portfolio to private lenders with fintech edge. Financial earnings are projected to grow at 13% CAGR to Rs 11.3 trillion by FY30. Fintech firms will grow from 11 billion to 421 billion by 2029, which is a 31% CAGR. Banking as a service, BaaS, will grow to 30 billion by 2030 at a 13.2% CAGR. Plausible returns, 12 to 20% annual, compounded over 5 to 10 years with short-term 13 to 16% earnings growth, yielding 20 to 33% stock upsides. at this overall growth forecast. To summarize, India's banking sector is a great opportunity for the growth of your investment. And that's a wrap from me, the Hedgenomist. The principle of our content creation is to arm you with knowledge that's hiding in plain sight, the kind that empowers you to make great investment choices. Thus, hedging based on knowledge and not guesswork. If this video sparks ideas, hit like, subscribe, and comment your thoughts below. Thank you for your time.